If you invest $200K in your lifetime, that 2% fee can cost you over $100,000 in lost growth. That's a six-figure loss. This is something banks just will not tell you, but because I've been there and I've moved on and I'm now in real estate, I will. Did you know most Canadians think they're using the TFSA properly, but the data says otherwise? According to a 2025 TD poll, 39% of TFSA holders are not investing any of the money inside of it, rising to 41% for both Gen Z and millennials. And then BMO found in their research that 47% of their TFSA holders have their savings in straight cash. This is just one of the top mistakes that people make in their TFSAs and probably the most costly one. But today, I'm going to break down the top 9 TFSA mistakes that Canadians make. Some of these mistakes will cost you tens of thousands, even hundreds of thousands down the line. And before we jump in, I'd just like to say that if you like these types of videos, then hit the subscribe button. That way, you won't miss out on one of my future uploads once they're posted, and I would truly appreciate it. With that being said, let's jump in. Mistake number 1 is not tracking contribution room properly. People contribute, withdraw, then recontribute, and then they're blindsided by the penalties. Look, here's what you need to know. Your total contribution room is the sum of all annual limits from the year you turned 18. Then, every year, the government announces new contribution room which is added to your total contribution room. If you withdraw from your TFSA, that room only gets added back on January 1st of the following year, not immediately. This is one of the most misunderstood rules. If you were at your max and took out $10,000 in June and put it back in September, that's an overcontribution, and the CRA charges a 1% penalty per month until it's fixed. According to the CRA annual reports, about 133,000 Canadians were found to have overcontributed to their TFSA in 2024, which they say is attributed to a lack of understanding the contribution rules. Mistake number 2 is keeping TFSA money in cash. This one is by far the worst one, mostly because it feels harmless, but also because of the opportunity cost. Doing this is no different than keeping cash in your wallet or in a safe or under your mattress. It earns nothing or close to, and it slowly loses value over time due to inflation. Here's what you need to know. Interest rates are based on the inflation rate. So the more inflation increases, the higher the rates will be. So when you see a bank offering a 5% GIC, just know that inflation is roughly up there also, if not more. Then when you consider that in Canada, average savings rates for savings accounts range between 1 to 2.5%, though some institutions might have promotional offers offering a much higher rate. But please read the fine print, because these promos only last a few months, guaranteed. You're not even actually getting the full percentage throughout the year. And then you compare that to the long-term return of the stock market, which is between 8 to 10% per year, depending on the index that you choose. That difference, compounded over 20 years, is a six-figure gap. And yes, there are times where keeping cash in your TFSA is a better option if you have short-term purchases planned or want to keep an emergency buffer. But over the long term, holding cash is a wealth killer.
Cash is always a bad investment.
Mistake number 3 is day trading in the TFSA. The CRA can and has gone after people who trade too frequently in their TFSA, calling it business activity. When that happens, your gains are no longer tax-free. They are considered business income, which is fully taxable. There are several well-documented cases where individuals with very active TFSA trading accounts got reassessed and had to pay tax on everything. So don't day trade in your TFSA. Mistake number 4 is choosing investments that don't match your goals. Look, traditionally, the two biggest things that determine your strategy are 1, your time horizon, and 2, your risk tolerance. But in my honest opinion, the only one that should have an actual impact on your investment decisions is your time horizon, because your risk tolerance should really just be a yes or no question whether or not you are ready to absorb risk with your investment. Let me explain. Your time horizon is just how long until you need the money. So if it's 1 year or less, then you want to avoid risk. You don't want to lose that money. So cash or GICs. 3 to 5 years? Well, look, it depends on whether or not you are ready to absorb risk. And anything 5 years or more should be invested in assets like ETFs, index funds, or growth mutual funds if you actually want to make money. Now, your risk tolerance is basically just how much volatility you are ready to accept, or in other words, how much fluctuation you are ready to accept. And the reason I think that risk tolerance should simply be a yes or no question is because during my experience as a financial advisor, I saw so many cases of clients getting steered into a low growth fund based on the answers to their investor profile. Now, this is something banks just will not tell you, but because I've been there and I've moved on and I'm now in real estate, I will. The investor profile is not to find the investment that best suits your needs. Although they say it is, it's not. Its goal is to minimize the liability for the bank. So if you ever end up losing money and then file a complaint, well, here's your investor profile that you filled out, your investments match your answers, plus here's your signature. If a bank's investor profile was truly working in your best interest, they would never recommend a mutual fund that charges above 2% management fees, which is also consistently underperforming versus the index every single year. And don't just think you're being safe by choosing a lower risk fund, because in most cases, these conservative mutual funds actually lose more money in down years compared to index funds because they still charge the high management fees regardless of your return. Then once the market bounces back, well, these conservative funds are usually only about 20% allocated to equity, which means you won't even capitalize from the rebound because you're stuck in bonds. So if you actually want your money to grow, you need to invest properly. And this point brings me right to mistake number 5, which is paying unnecessary investing fees. Canadian mutual funds have some of the highest fees in the world, even ranking dead last in 2017. So remember, banks always get paid before you. A typical mutual fund MER is usually around 2%. Meanwhile, a typical ETF can cost anywhere between 0.05 to 0.3%. That is a huge difference. If you invest $200K in your lifetime, that 2% fee can cost you over $100,000 in lost growth. That's a 6-figure loss. And if you're paying all these fees to consistently underperform against the index year after year, I'm sorry, but you need to wake up. Mistake number 6 is not automating contributions. One of the simplest but most powerful improvements that you can make is just simply automating it. People naturally don't invest consistently because they rely on motivation. Automating your TFSA contributions solves that problem. And the real power comes from compounding, where your money is put to work and the growth is reinvested over time, making a huge difference. And then there's dollar cost averaging, where if you invest an amount regularly through pre-authorized contributions, then you'll be better able to handle the ups and downs of the market. Now, the strategy is best used to minimize risk. When the price is low, you will buy more units. And when the price is high, you will buy less units, thus lowers the average cost of the units that you buy. Mistake number 7 is putting extremely high risk assets in the TFSA. People think if I'm gonna gamble, might as well gamble tax-free. Look, the problem is if you lose $20,000 in a TFSA, you don't magically get that contribution room back. So whether you're holding a few individual stocks or just panic selling during dips, you are just sabotaging yourself. Diversify, do your research, and think long term. Mistake number 8 is thinking the TFSA affects government benefits. Look, a lot of retirees still think that the TFSA affects their government pensions. It doesn't. That's why it's called the tax-free savings account. You don't pay taxes on growth or withdrawals. Therefore, it doesn't affect your annual income. TFSA withdrawals do not affect CPP, OAS, GIS, or any other income-related benefits because it's just never applied as income. This makes the TFSA a very powerful tool for retirement planning, especially for young Canadians, since they will accumulate more contribution room every single year. If you're planning long-term, the TFSA is essential. Mistake number 9 is naming your spouse as a beneficiary. Look, this one matters only once in your life, but it matters a lot. People are adding their spouse as a beneficiary when in reality they should be adding them as a successor holder. What's the difference? Well, a successor holder, which is the best option, your spouse becomes the new owner of your TFSA immediately, and the account stays tax-free unchanged. Now, only your spouse or common law can actually be named as a successor holder of a tax-free savings account. Whereas if you name them a beneficiary, well then your spouse receives the money, but it's withdrawn from the TFSA. So if they want to add it back into their TFSA, they will need to have the available contribution room to do so. In both options, your spouse will receive the money, but as a successor holder, it will remain in the tax-free account. A much better option. There you have it. These are the top 9 TFSA mistakes that I see Canadians make all the time. If you avoid just even a few of these, you'll be ahead of the average investor. If you liked this video or found it helpful, then consider hitting the like and subscribe button. It helps more people find this video, but that way you won't miss one of my future uploads once they're posted, and I would truly appreciate it. Let me know in the comments below if you have another topic that you'd like me to cover. I read every single one. Thanks for watching. Until next time.